In today's video, I'm going to show you how I zoom into the 1 minute chart to get the perfect entries for my higher time frame trades. My name is Lou Burton, I've been trading the Forex markets for over 7 years. Now let's get into today's video. Okay, so I'm going to break down a concept that a lot of traders find very difficult to understand in a step-by-step easy process. For you to understand how to do this, you first need to understand how I see the time frames. So I don't look at time frames as one single time frame or separate entities. They're all just a representation of the same data point. We're just zooming in and zooming out to see this data represented in multiple ways. So let me show you what I mean. Now we first need to understand on the charts here that we have candles, right? All we're doing is reading these candles, understanding these candles as they're being printed and as they've previously been printed, so that we can look for good trading locations and we can read the direction of the market. So when I say that the data is all represented as one entity, what I'm saying is that if we can learn to read these candles and what they mean and where to look for these candles, these time frames essentially, all we're doing is just zooming in and out of that same data point. So for example, a sideways range is a candle that shows price contained between a high and a low point. So for example, we could have a doji candle. That's a representation of a sideways range. So if that was represented on the 15-minute chart, if we was to zoom in to, let's say, a 5-minute or 1-minute chart, what we'll see on the lower time frame is a representation of a sideways range. So we're just zooming in to see the perspective of that sideways range. And then what we can do with that data is find the specific candle that price could react out from. Also, we have inside bars. That's where price initiates down in a candle like so. And then we have this low and this high within the candle. And the next candle doesn't close above or below that high or low. That shows an inside bar, which shows a sideways range. So if that is printed on the 15-minute chart, when we zoom into the 1-minute chart, we know that that is a sideways range. And that's exactly where we're going to be looking for our orders. So we're just zooming into this area with the understanding from the higher time frame chart. So the same if we have an initiation here on the 15-minute chart, which is that aggressive selling within the market, we know that on the lower time frames, we're just going to get markets which look a lot like this. Move down, ranges, and continuations to the downside, and that creates that initiation structure in the market. If we saw this price delivery on the 1-minute chart, if we was to go up to the higher time frame, this is the representation that we would have of that initiation structure in the market. When we get trending markets, which is price moving in that lower high or lower low fashion, that's where we'll start to see a lot of candles that have wicks on the bottom, and then the next candle moving back up with a wick and a wick on this side, and then the next candle will move down. And that is a representation of price moving down, pulling back, continuing, and that's creating that trending fashion in the markets. So once we can understand that the representation of the data that we're looking for is just the concepts, then we can zoom in and out of the time frames and we can look for these concepts and look to read the price delivery. Going back to the 15-minute chart, and what are we doing? We're looking at a candle that's now being reacted out from. So between this high and between this low, price was ranging, was moving in a sideways range. This is a candle that has wicks on both sides with a body in the middle. That shows price contained sideways between that high and that low. And the next candle broke out to the downside, which is that bearish initiation candle. So we know that between this area, when price comes back here in the future, we have to react out. And this is what this reaction candle is here, is price reacting out of the orders created inside the sideways range. So now if we go down to the lower time frame, we will see a representation of a sideways range. So let's zoom in to the 1-minute chart, and what can we see? We can see that price was contained between this low point and this high point. Now, inside the sideways range is where I say we always look for those orders, which is where the orders are created. And that's what we can see, right? We get a high, a low, price runs above the high and initiates in the opposite direction. So we see the manipulation within the sideways range. So if we were looking to trade based out of this sideways range, this is the area that we would look to be trading from in the future. So again, just by reading through the candles and understanding the perspective of zooming in and zooming out of this location, by understanding firstly on the higher time frame what candles we have with the concepts, and then understanding what sort of price delivery that should look like on the lower time frame, and then we can understand from that perspective of it's a sideways range is where the orders have to be created in the market. Now we have to look for our candle which represents those orders, And once we've found that, we can find a trading location. So let's zoom out back to the 15-minute chart again. Again, that's just an understanding of current price. And let's do the same thing, right? Let's have a look at that same understanding, but let's think about how we can read price delivery, right? This is a A to B price range at the moment. So let's just go back. Now, another representation of a sideways range will be price contained between a low point and a high point between the candles. That represents a sideways range on the higher time frame, the 15-minute chart. So if we again zoom into this area, this is where we should see a representation of a sideways range. So let's zoom in now, firstly to the 5-minute. What can we see on the 5-minute? When we zoom in, we can see a doji candle. Again, a doji candle is a representation of a sideways range. And obviously the next candle we see is that initiation candle, which is price contained sideways in a sideways range. This is where banks create their orders, and representation of a sideways range is a doji candle. So we've already seen a new representation. Again, across the time frames, when we zoom in, we're just seeing a representation of the same data. It's just represented in a different way. So now if we go down to the lower time frame, we go to the 1-minute chart, what can we see? In that area, we can see that price took out the low here, took out the high here before initiating to the downside. Now, when sideways ranges are created, manipulation happens. So we take the lows, take the highs, and initiate in the opposite direction. So when we're seeing lows and highs taken, that's a representation of a sideways range. So again, like I said before, we know where we're looking for because we can read it between the candles on the 15-minute. When we go to the 5-minute, which means when we zoom in a little bit more, we can see a same representation of that data represented differently in a doji candle. Now, when we get to the 1-minute, again, we get the same representation of the data, just represented differently, right? And that's how we find our sideways ranges, and that's how we find our specific locations that price will react from in the future. Now, when price gets here in the future, you don't necessarily have to take it as a reaction, but you could with your stop above the high. You could wait for price to get here, show you its intention again, play that pullback and play a continuation. And this is normally how we trade these opportunities. It's about finding the location, price showing that it wants to continue in that direction again, and then you take that pullback continuation with a safe stop. So that's the representations of a sideways range. Now let's think about how it's represented as an initiation structure. So again, as I said, when we're on the 1-minute chart, and let's zoom in and do this on the 1-minute chart, right? When we're on the 1-minute chart and price is moving very aggressively, we see a lot of imbalance created in the market. Now, if price doesn't pull back from this imbalance and create a trend, we know that that's an initiation structure. Now, what's that going to be represented as on the higher time frame? That is going to be represented as a bar down with imbalance created in this market. Again, the data that's being represented on the 1-minute is initiation structure. So that means that this initiation structure on the higher time frame, if we zoom out, should show us imbalance created in the market. So let's zoom out to the 5-minute. Again, on the 5-minute, we can see that imbalance within the candle already. 10-minute, again, we see the imbalance created. I'm just going to remove this so you can see it easily. You can see between this low and this low here, that's an imbalance created. Now, the further up the time frames we go, all this is going to do is just merge into one candle because it's representing that time it took for price to move down. So again, let's go up 15-minute. Again, we see the imbalance in the candle. 20-minute, again, imbalance. 30-minute imbalance, 45. And all we're doing is just zooming out more and more and more and more and more. And eventually this will just show as a wick on a time frame because we've moved down here, we've reacted, and now we're moving back up. So again, that's just going to be a representation of a strong rejection, which is a wick the further up the time frames that we go, as we see here. Now let's have a look at the representation of a trend. As I said before, that will be candles moving down, then price pulling back, and then the next candle moving down again, price pulling back, the next candle moving down. Obviously as well, we might have wicks on either side of these candles. The wicks aren't really that important. The wicks are only important when you're looking through the time frames. For example, you're seeing a move down followed by very large wicks to the downside, and then you're seeing a price moving back up followed by another move down, right? We have to understand that price has moved down, it's created a low, it's pulled back, created a high, and it's created a new low in the market. That's the same representation that we're seeing here, and it is literally just price moving in a trend on the lower time frame. So on the higher time frame, we might have 3 or 4 candles, which shows price creating lows, highs, and new lows in the market. That's a representation of price trending on a higher time frame. Now, if we was to go down to the lower time frame, we'll see those nice legs down like so. And these will be representations of initiations, pullbacks, and initiations within the market. So let's have a look at that now. So we can see here, just within this up leg here, again, this is on the opposite side, but we can see lots of candles here where price created a high, we got that pullback, we created a new high, we got that pullback, and we created that new high within the market. That's showing price trending. It's showing the representation of price trending within the market. Reading this on the higher time frame. Now, if we went down onto the minute chart, and again, we zoomed into this area, this is going to show a 1 minute trend. So we just zoomed in here on the 1 minute chart, and as we can see the trend, right? We got the low, high, higher low, higher high, higher low, higher high, higher low, and again, higher high in the market. So we're seeing the representation of the higher time frame by zooming out and understanding how to read the candles. And we're zooming in on the 1 minute chart, and we're able to understand that we're in a trending market. So you can do this on any time frame. Again, all I'm doing is just reading the candles. I'm just using 2 time frames together. If you was to do the same on the 1 hour chart, you can use exactly the same candles, exactly the same understanding to read the markets and to find areas to trade from. Again, we're always looking for a sideways range to look for a reaction point in the market, followed by an initiation. When price pulls back into this location, we look for the order block inside the sideways range, because this is where orders are created. And this is where we can look for our opportunity in the future to play that intention again. So all the candles that we're reading is either going to be a sideways range, it's going to be an imbalance candle, which is an initiation, or the price is going to be moving in a trend. And when it's moving in a trend and it's moving slower within the market, we have to understand that we have to wait for those pullbacks into good locations to then trade continuations. The same way that if we was to look at price right now, we can see that we did react from the range, we have a move up, we have a pullback, and now we're in continuation. So we're in a trending market on the lower time frame. So I would know that I would have to wait for a pullback into a good location. Again, if we look at the market here, we can see that we're in that trend, right? Trending market, we're getting those deeper pullbacks. So if I was going to trade this, I would wait for price to at least pull back into the 50% area, into that discounted area. And then that's where I would be looking for my sideways ranges here, in order to trade this for a continuation here to the upside. If I was looking for buys, like I said, I'm looking for the candle that has run the low, shows manipulation before initiating in the opposite direction. And that would give me my trading location, which would be in this candle here. And then that's how you can play that with a stop underneath the low of the range and play that as a continuation of that momentum there to the upside. So it's about reading the candles first, understanding the concepts, and then you can look for the entry just by zooming in and zooming out and understanding how to read price. So with that being said, the time frame shows us the information on how to read the market, what structure we're currently in, but also where to look for reactions and why. So something else that's also important is time frames aligning is telling us that market wants to move in that direction. So for example, if the higher time frame is showing us a bearish trend or a bearish move in the market, that would mean that momentum is currently bearish. So we can see here on the higher time frame, we've had a momentum shift and we're now bearish. So now that's the time frame on the higher time frame showing us that price wants to move down. And the reason it's done that is because we've broken structure and we've shown the momentum is bearish. So the 15-minute momentum is bearish. Now, if we was to be bullish on the lower time frame, let's say the 1 minute chart, we would go down onto the 1 minute chart and we're seeing bullish structure in the market. These time frames are both telling us completely different directions in the market. One time frame is telling us it wants to move lower. One time frame is telling us it wants to move higher. Now, if this time frame here on the 1 minute, let's say this is a 1 minute chart here, and this is the 15-minute chart here, which is bearish. If the 1 minute chart also shows a momentum shift, now we have 2 time frames. We have a higher time frame and a 1 minute chart, both showing us that it wants to move lower. So if you're taking trades in the direction of the higher time frame and the lower time frame, and they're both correlated together and showing us the same direction, you're going to increase the probability of catching winning trades, because multiple time frames are showing you the same direction. And this is reading price again. We're reading the higher time frame and the lower time frame together. We are correlating both of those time frames, and the correlation tells us price wants to move lower. And this is called time frame confluence. And confluence is a concept or an understanding that gives you directional bias or an edge, or multiple confluences giving you an edge. So a lot of traders, what they do is they try to make sure that the daily chart is bullish, the 4 hour chart is bullish, the 1 hour chart is bullish, the 15's bullish, and then I'm looking for the 1 minute to be bullish. Yes, this is great because all timeframes are showing you the same direction. However, you don't need all those timeframes. Just pick 2, right? Understand the direction on the 15-minute chart, which is the intraday direction, and understand that the 1 minute chart also shows that same direction. That's enough confluence to look for a trade. You don't need to have every single time frame showing you the same direction in order to find a high probability trade. It's just about having 2 time frames showing you the same direction, and that can be enough for the price to move 10, 15, 20 pips, and that can equal take profit in the market. So for example, if you use the 1 hour chart and you enter on the 5-minute chart, then understand when the 1 hour is bullish, you're going to be looking for the 5-minute to also be bullish, so you can have time frame confluence, and then you will hit more winning trades because the market is showing you it wants to move bullish on both time frames. And that's how you're creating high probability trades in the market. If you enter on the higher time frame, for example, let's say you enter on the 1 hour chart, then maybe you want to make sure that the daily chart is bullish, and you also want to make sure that the 1 hour chart is bullish. Then you have time frame confluence. So I hope all this makes sense. This is a part of my edge in the market, and this is what we always show at NJT, how to create that edge in the market, how to create more winning trades, how to create higher probability trades in the market, and how to read the price delivery, right? Because once you understand RAMC and you understand how to read intention, you can read through any candles on any time frames, and you can understand the perspective that we're just zooming in and out to get a representation of the same data.
This week's community winners.
I hope you all enjoyed the video. Leave us a like and comment if you did. If you want to see more of these videos as well, make sure you let us know down in the comments. And if you want to find out more about how we trade these markets, you can visit our website at notjusttrade.com. And I'll catch you guys on the next video.